silver is up almost $6. It's trading at 84.28. That's up 586. So silver's got a 7.5% gain. Big move. Gold is now up $110. We're above 51. We're at 51.05. It's telling you this is the canary in the economic coal mine. We're coming to a currency crisis. Gold is giving you an early warning that that's coming, and a sovereign debt crisis. So you want to load up, want to buy your gold, want to buy your silver, and again, get into these mining stocks. My guess is we're going to have a delayed reaction to this news in gold and silver next week, which is why you should buy this week. In general, I expect a lot of strength over the weekend, and I think when the Asian markets open Sunday night and react not only to the tariff news, I think you're going to see big rallies. So the Fed keeps saying that inflation expectations are well anchored at 2%. Where? Who the hell expects 2% inflation? Just the Fed. The biggest reaction in the markets was in precious metals. Now, gold was already up about $50 before the news broke. Silver was up about $2. Immediately following the decision, gold lost its entire gain. It sold off to down a few bucks. Silver never really went negative, but it lost most of its gains. Didn't know why, didn't make any sense. And none of the other markets really reacted much at all. Then gold and silver came roaring back. And as I'm recording this, it's about 4:45 East Coast time. Gold's up $102 an ounce. It's almost back at 5,100. It's a strong gain now on the week, up better than $100 on the week. Silver is up almost $6. It's trading at 84.28. That's up 586. So silver's got a 7.5% gain. Big move. I mean, gold's 2% gain is not that shabby either. I mean, none of the markets had this big a reaction to Trump's or to the Supreme Court's decision.
Gold and silver are moving sharply while the rest of the market sits idle, signaling real stress points. Peter Schiff has highlighted this pattern repeatedly, and the $102 gain in gold with silver, up 7.5%, confirms it's not algorithmic noise. The initial post-decision dip exposed short-term volatility, but sustained buying shows genuine market demand. Retail and institutional investors ignoring metals risk missing out as traditional safe assets lag behind. Next, Peter Schiff explains why these metals gains could accelerate even faster than most traders expect this week.
Now, before we got that decision, we got a lot of bad economic news that should have been very good for gold and silver. And I'm actually surprised that gold and silver didn't move even more, because gold was up about $50 before all this bad economic data came out that should have caused gold to rally, but it didn't. Now, my guess is we're going to have a delayed reaction to the gold and silver, to this news in gold and silver next week, which is why you should buy this week. Now, I know a week ago I told people to just go to the Schiff Gold website and buy gold and silver. Don't wait for Monday or Tuesday. I thought it would be cheaper to buy over the weekend, and it turned out I was wrong. You would have got a better buy had you waited for Monday. But doesn't matter. If you bought last weekend, you're still ahead. You're still, at least $100 ahead on gold and $6-7 ahead on silver. So it didn't matter, even if you missed out on a better buy on Monday.
Bad economic news should have triggered a bigger rally in precious metals. Peter Schiff has consistently warned that headlines understate safe haven value, and here gold moved modestly while silver's gains remain strong, showing delayed reactions are common. Investors are still $100 ahead on gold and $6 to $7 on silver, even if timing wasn't perfect. Long-term portfolios benefit from holding physical metals rather than chasing short-term timing. And Peter Schiff next highlights why buying this week could strategically outperform waiting until Monday's open.
But I think that's going to be the exception, not the rule. In general, I expect a lot of strength over the weekend. And I think when the Asian markets open Sunday night and react not only to the tariff news, but to the bad economic news, which I'm going to get to in a moment, I think you're going to see big rallies. So once again, I would not wait for Monday. After you finish listening to or watching this market wrap, if you got extra cash, buy some more gold and silver, whether for physical delivery at Schiff Gold or go to T-Gold, and we'll store it for you. And I'm still building out the T-Gold platform, but you can still lock up your gold and silver right now and have it and get these prices before we go higher. Now, the Fed keeps saying that inflation expectations are well anchored at 2%. Where? Who the hell expects 2% inflation? Just the Fed, nobody else. But the reality is, I think that the consumer is closer to being right than the Fed, but I think he is likely still understating it.
Weekend trading could reveal the real strength of gold and silver before US markets react. Peter Schiff has emphasized that official inflation metrics understate reality, and Asian market moves could push metals even higher. Platforms offering physical delivery now reflect true demand, unlike paper markets. Fed claims of anchored inflation contrast with rising consumer prices, challenging standard risk models. Investors sitting in cash may face opportunity costs as metals continue to outperform traditional assets. And Peter Schiff next explains why this weekend surge might make Monday a missed opportunity for late buyers.
By the way, as I'm watching, the gold and silver prices are still adjusting. Gold is now up $110. We're above 51. We're at 51.05. And silver's up over $6 now. $6.09. We're at 84.50 on silver. I mean, what are these the percentage gains here now on the day? Gold's up 2.25%, and silver's up 7.8%, almost 8% on the day. And nobody's talking about it. I was watching the financial news again all day as they're covering the reaction to the news on the tariffs. Nobody talked about precious metals. And that's where you had a big move. Yeah, the dollar was a little weaker. Bonds were a little weaker. Stock market went up a little bit. You know what did nothing? Bitcoin, right? Bitcoin is still 67,700. Yeah, it was up like 1.3% on the day. Not as much as gold was up. It was up, but it was, it's still nowhere. It's still below 70,000. It's still below the 69,000 peak that it hit in November of 2021. Right? And
precious metals are quietly outperforming while mainstream coverage ignores the gains. Peter Schiff notes that gold's $110 jump and silver's nearly 8% gain highlight investor focus on hard assets over stocks or crypto. Dollar weakness and muted equity reactions underscore that headline, markets are missing real risk signals. Retail investors paying attention can capitalize on metals momentum before broader recognition. And Peter Schiff next reveals why ignoring this move now could leave portfolios underexposed to tangible asset growth.
And the media is still fascinated with this crypto bubble. They don't even realize that it's popped and all the air is about to come out and all their viewers are about to get wiped out. But that's what's going to happen. And again, if you're still holding Bitcoin, do yourself a favor and sell it this weekend. You're lucky that it hasn't already, dropped through the floor. I don't know what's taking it so long. Look at a chart. Zoom out. All these crypto guys are always telling me to zoom out. Well, zoom out. It's ugly. Yes, there was a big rise, but it's crashing now. Look at what it looks like on a chart. And you tell me that that's not going to keep falling. Look, if Bitcoin breaks 50,000, which seems like a high probability event to me, you look at that chart. There's nothing that's going to stop it from going to 20,000. So, why ride it down to 20,000? If you have to, you can buy it back down there. I wouldn't, but get out now. Get into some gold and silver. We make it easy at Schiff Gold with BitPay. You can easily sell your Bitcoin and get some gold or silver. And, we're not going to stop at 20,000. I mean, maybe around 20,000, maybe there'll be a bounce. Maybe it'll go back up to 30,000. Everybody be excited. Hell, we're going to the moon. Then the next thing you know, we're going to be 10,000.
Crypto hype blinds investors to the unfolding collapse in Bitcoin, signaling a sharp risk for anyone still holding. Peter Schiff has repeatedly warned that speculative bubbles like this pop violently, and charts show Bitcoin could fall from 50,000 toward 20,000 with little support. Selling now and shifting into tangible assets like gold and silver protects wealth as markets recalibrate. Retail investors ignoring metals risk steep losses while crypto's volatility dominates headlines. Next, Peter Schiff explains why exiting Bitcoin now is crucial before the next leg down accelerates further.
I expect there to be a bigger reaction to what's going on. I mean, it shows me that Trump is trying to do things that are illegal. I think that confidence is being lost in the administration. The lies that are being told about how great the economy is, how strong the economy is, are being exposed as exactly that. The data belies all of this talk about how hot our economy is, how strong our economy is. It's not. And it's only going to weaken, especially as the dollar really rolls over, as that spills into the bond market and long-term rates start to back up and the Fed is really forced to start printing even more money. That is exactly what's going to happen. And Trump, again today, reiterated his false claim that the world has been ripping us off, that they've been screwing us over, and that they need to be punished. What exactly have they been doing? They have been supplying America with goods that we can't produce, that we don't have the factories and the infrastructure and the supply chains.
Confidence in the administration is eroding as economic claims clash with real data, creating uncertainty across markets. Peter Schiff highlights that when the dollar weakens and long-term rates rise, the Fed may be forced to print more money, amplifying inflation risk. Investors should consider hedging with gold and silver, rather than relying on paper assets or political promises. Trump's rhetoric on trade may shift sentiment, but fundamentals suggest structural vulnerabilities are building. Next, Peter Schiff emphasizes why these macro pressures could trigger a broader market correction before most traders react.
We can't build these goods ourselves, and if it wasn't for the rest of the world, we wouldn't have them. So the world supplies us with stuff that we can't produce at low prices. So our lives are improved because the world is ripping us off. What does the world get? All the people who are ripping us off, what do they get out of the deal? Well, we print up money and give it to them. Cost us nothing, create it out of thin air, and the world just takes our IOUs. So we import their stuff, and they import our inflation. We export inflation, we import goods. If the world stops ripping us off, what's going to happen? Well, we're not going to get the goods anymore. We're going to be stuck with the inflation. So we're going to have a country with empty shelves and sky-high prices. And lots of people are going to be unemployed because if there's nothing to buy because we can't afford anything and nothing is here, then all the FedEx jobs and the UPS jobs, those are our biggest employers.
Our dependence on global supply chains masks the hidden cost of imported goods, creating inflation exposure at home. Peter Schiff has repeatedly warned that printing money to pay for imports transfers inflation abroad, while domestic consumers face shortages. If imports stop, empty shelves and high prices could trigger rising unemployment, particularly in delivery and logistics sectors. Gold and silver provide a tangible hedge against this systemic risk, unlike cash or bonds. Next, Peter Schiff explains why investors should consider metals now before domestic shortages intensify further.
All they do is move around the stuff that we import. Well, if we can't import anything anymore, well, we don't need all these delivery trucks. The other big employers are Walmart and Amazon. Well, what do people buy at Walmart and Amazon? All these things that we got imported. All the things, we're being ripped off. And because we're being ripped off, there's all kinds of stuff that we could buy at Amazon and Walmart. Well, when the world stops ripping us off, well, there's nothing left for us to buy. And so if Walmart and Amazon, if they're not selling stuff anymore, they don't need all these workers. So not only do we have sky-high prices, but we have soaring unemployment. That's what happens when the world stops ripping us off. But what happens to the world? The world's going to have an economic boom. The world gets to keep all their stuff. All those consumer goods that they were shipping to America, they get to keep those goods. They get to enjoy those goods. They get to consume those goods.
The US economy's reliance on imports conceals a fragile labor structure tied to consumption. Peter Schiff highlights that if imports halt, not only do prices soar, but jobs in logistics, retail, and delivery vanish. Walmart and Amazon would see declining demand, driving unemployment higher while inflation persists. Meanwhile, the rest of the world benefits, enjoying the goods without the domestic cost. Investors ignoring this dynamic risk, missing the asymmetric growth opportunity in hard assets like gold and silver. Next, Peter Schiff explains why hedging with metals is critical before this import-driven imbalance worsens.
Better for them, right? We miss out, but now they get the fruits of their labor. And what happens to their savings that they were loaning to us? They were buying our treasury bonds, our mortgage-backed securities. Well, now they have all the savings still. They can invest that money locally. They can invest in funding more capital investment, factories. They have the money themselves. They have more capital. They have more consumer goods. They have a higher standard of living. They have stronger economic growth. The world benefits when they stop ripping us off because they're not really ripping us off. We're ripping them off. We are a burden that the world has borne. And I think what's going to be happening in the very, very near future is that the world is going to remove itself, liberate. The Liberation Day is when the burden of supporting the U.S. economy is lifted from the backs of the global economy. And then we here in America, we're left to fend for ourselves.
Global investors are reclaiming control over capital once tied up in US debt, signaling a structural shift in economic power. Peter Schiff points out that these funds will now boost local production and consumer goods abroad, raising standards of living and accelerating growth outside the US. For American investors, this means higher risk in domestic markets and rising vulnerability to inflation and currency pressure. Traditional safe assets may no longer provide the same protection. Next, Peter Schiff explains why this withdrawal of global support could sharply expose the US economy sooner than most anticipate.
Now we can't live beyond our means. If we want to consume, we got to produce. If we want to borrow, well, then we got to save. We can't rely on the world's production and the world's savings. So this is a game changer. It's going to be an eye-opener. It's going to be a major realignment of global purchasing power, global living standards, and people need to react in advance. You need to prepare yourself for this coming dollar crisis, this coming sovereign debt crisis. Gold at $5,000 an ounce, or now $5,100 and change. It's telling you this is the canary in the economic coal mine. We're coming to a currency crisis. Gold is giving you an early warning that that's coming, and a sovereign debt crisis. So you want to load up, want to buy your gold, want to buy your silver, and again, get into these mining stocks. They were up today, but not nearly as much as they should. In fact, when gold and silver sold off, gold mining stocks, which were all strong on the day, all went negative.
The US dollar's weakening and the warning signs in gold at $5,100 signal rising sovereign debt risk and currency stress. Peter Schiff emphasizes that gold is the canary in the economic coal mine, highlighting imminent risks ignored by most investors. While gold and silver rally, mining stocks remain underappreciated, offering potential for outsized gains if markets correct. Retail and institutional investors must prepare now or face losses as global financial imbalances intensify. Next, Peter Schiff underscores why ignoring these early warning signs could leave portfolios exposed during the next crisis.
Some of them were down 4 or 5%. Crazy. And then when the gold and silver came back and made new highs, many of the gold stocks still ended in the negative. The GDX still ended up positive, just under 2%, and the GDXJ just under 3%. But these should have been much bigger moves. And I think there will be much bigger move. The Wall Street is still in complete denial regarding what is going on in gold and silver. They have no idea why prices have moved up. They expect that the prices are going to come down. They're wrong, just like they've been wrong the entire rally. And that's why they're not buying these gold stocks. And of course, if they really understood the warning that gold was sounding, they would be dumping bonds, they would be dumping their tech stocks, and they would be pouring their own money into gold and silver, into these mining stocks.
Despite gold and silver reaching new highs, Wall Street remains oblivious, leaving gold stocks undervalued relative to the metals themselves. Peter Schiff notes that institutional denial is preventing rational allocation into mining equities, even as bonds and tech stocks should be sold to balance risk. This disconnect creates a rare opportunity for investors to act while markets lag behind actual value trends. Ignoring the signals now could cost portfolios significantly once broader recognition hits.